Hello everyone, my name is Prathamesh Abru and I am going to explain you an important topics of financial accounting, which is share capital and reserve and surplus in company final accounts. So these two items appear in the liability side of the balance sheet and helps us to understand the financial strength of the company. So in this video, I will explain you this concept in the simple and practical way. So let's get started. So first is let's understand the share capital. In the simple word, it is a owner's contribution of the company. Whenever a company needs funds, it is issued shares and the money received from shareholders, it is called share capital. Now, share capital is divided into two types. First, authorized share capital. This is a maximum amount of capital the company allows to raise. Next, issued share capital. This is a part of authorized share capital that's offered to the public. Sub- now next, subscribed capital. This is the amount of actually subscribed by investors. Paid up share capital. This is the amount received from the company from the shareholders. These are the four types of share capital. For example, if a company issues 1 lakh shares of 10 rupees each and received full payment, and the paid up share capital will be 10 lakh rupees. So the share capital represent the basic ownership structure of the company. Now we have to understand what is reserves and surplus. Now let's understand reserve and surplus. Reserve and surplus are represented the accumulated profit of the company that are kept. Understand the reserve and surplus. Reserve and surplus represent the accumulated profit of the company that are kept aside for the future use. Unlike share capital, reserve are created from profits earned by the business. These are the different types of reserves. There are four different types of reserves. First is general reserve, credited out of the profit for the future expansion of emergencies. Second, capital reserve, created from capital profit like profit on sales of fixed assets. Next is securities premium. Uh, if in company extra amount received over above face value of the shares, this is share premium. Securities premium. Surplus, what is surplus? This is a balance of profit left after paying dividends. We understand the four types of reserve. Let's understand the example. If a company earns profit and does not distribute into the entire amount as a dividend, the remaining profit becomes surplus. Surplus and reserve helps in the financial stability, expansion and dividend policies. Now, we have to find out the difference between the share capital and reserve. Now, let's see the difference between the share capital and reserve. Share capital comes from the shareholders, while reserve comes from the profits. Share capital is permanent, whereas reserve are accumulated over time. Share capital cannot easily return, but the reserve can be used for business needs. Both are shown on the liability side of the balance sheet. This difference helps clearly understand the source of the fund of the company. Importance in company final accounts. Share capital and reserves and surplus are very important in the final accounts of the company. Because why the importance in the company final accounts? They shows the financial strength of the company. They helps investor to judge and the stability, growth and potential of the company. They indicates how much profit is retained in the business. This supports long-term planning and decision making. Understanding this concept fulfills with the elaborating theoretical parts of the financial accounting. Let's come to the conclusion. To conclude that the share capital shows the owner's contribution and reserve and surplus how the internal strength of the profitability of the company. Together, they reflect the true financial position of the company. So that's about it. Thanks for watching this video.